Greetings, everybody, and welcome back to another episode of the Cadre Animal Health Real Estate Channel. Thanks for joining us. I'm your host, Ron Evans, coming to you from the great city of Austin, Texas. We are a family of commercial real estate companies, including Cadre Construction and Cadre Animal Health Real Estate, Bluefin Design, Paramount Floors, and Kudu Realty. Today, we are joined by my friend and colleague, Brei Silvia of Live Oak Bank. Hey, Brei.
Hi, thank you for having me.
Thanks for being back. I appreciate it. Just as a quick reminder, the content that we provide here, I hope is educational and informative to you. If you like it, please give us a thumbs up, subscribe to the channel, and consider reaching out to us with your real estate questions. We'll provide an email address and a website in the comments below. So, Brei, last time that we talked was kind of our intro to you, to Live Oak, and a little bit about the SBA versus conventional question. Can you give us a quick synopsis of how that conversation that we had on the last episode?
Sure. So in the 7A world or the SBA worlds, there are two different various products that are most popular in that borrowers will work with, and that's the 7A product and the 504 product. There are other SBA programs out there. You may have heard if there's a hurricane, there's SBA disaster loan programs. There's all kind of SBA programs. Okay. But when working with small business owners and they're looking to either start, expand, build, essentially grow their practice, they're looking at the two most popular programs, which is the SBA 7A and SBA 504.
Okay. Distinguish between those.
So the distinct difference is on a 504 loan, it's for fixed assets only. It's only for assets that have a useful life greater than 10 years, which for the most part puts you in the world of equipment and real estate.
Okay.
So you can't borrow money in the 504 program for working capital or inventory or anything along those lines. The 7A program, we call it the universal program. That particular program can be used for virtually anything. Acquire a practice, leasehold improvements, expansion, ground up construction, purchase real estate, partner buyout, working capital, you name it. It's a universal program that can be used for anything.
Okay. I'm chuckling a little bit right now because I swear I thought you said a choir practice. I thought you can really use your funds to go to choir practice? To acquire a practice.
Acquire a practice.
Yes, I caught up. So most of your loans through Live Oak, most of your borrowers, 7A?
Most of our borrowers are 7A. They're looking to for a larger facility. They've outgrown their current facility. Maybe they're tired of paying their landlord. They're ready to divest and not only invest more into their practice, but want real estate ownership. So predominantly what we do is ground up construction, real estate acquisition.
Okay, which is why we're a good fit because that's what we do. So let's talk then about let's talk about established versus first-time borrowers. I know there are programs out there where an established veterinarian and an established practice, so not necessarily someone who's just been practicing, but someone who has a business, right? They own their own business already. They can get potentially 90 or up to 100% financing for their real estate. Let's say a ground up. Is that correct?
Correct.
Okay. But a startup practice, how's that different?
So as a startup, the SBA has a certain set of rules that all lenders have to adhere to. Right. This is where there's parity in the product. When you are a startup practice, there's a 10% down on a 7A loan. Okay. And on a 504 loan, it's a 15% down payment. And so the 7A loan requires that. Now, for these types of projects, speaking specifically to ground up construction, any money that is spent that is essential towards the project, whether it's money towards the land purchase or you've paid an architect, or maybe you've paid an attorney to help you rezone the property. Anything that is essential to your project counts towards your down payment. But a startup does have to put money down, 10% 7A, 15% 504. If you are an existing practice and your down payment requirement, you don't have to put any money down. You can have as little as 100% financing through a lender. It's all predicated on what the lender wants to do. I would say if you are not working with a veterinary lender and you were to walk into your local bank, they are going to want you to put 10% down towards your project. But that is more the bank's criteria, not the requirements set forth by SBA.
Okay. So if the established borrower comes to you and you underwrite their loan and they close on their loan, they can then begin paying for soft costs. You mentioned some of them. So let's say it's architecture and design, civil engineering. And to be clear, civil engineers, a lot of people hear the word, but they don't know what it means. They're the architects of the land, right? So they help design the parking lots and the wet and dry utilities and the detention ponds, as we all need here in Central Texas, and I think in your area in Dallas as well. So those fees, they could close on their loan, begin drawing from those funds to pay for those soft costs. But a startup might not have that luxury.
Correct.
Okay. So walk us through, I'm a startup borrower and I say, well, maybe I've already got a piece of land, or maybe I'm acquiring a piece of land. I'm going to put some money down on that. I've got to then begin spending funds on those costs?
Yes, and I would say that's true whether you're a startup or you are an existing practice, Ron. And the reason for that is, especially, we'll probably get to this in another segment, in today's day and age, by the time you start design, you're probably 6 months away, if you're lucky, from being able to break ground, if you're lucky. And so we want to make sure our borrowers are properly capitalized. Any bank rightfully would. And in order to make sure they're properly capitalized, we don't want to guess at budgeted numbers. So initially, we always recommend working with a developer who has a team in place that can investigate under the ground, which is the civil, and we have an architect that can investigate above the ground. And it's very important because we're trying to determine each land has its own cost and set of circumstances, whether it be utility lines, sewer, a detention pond, a deceleration lane, or who knows, we don't want you to buy a property where there's a protected tree right in the middle of the site. And
or a warbler or a salamander.
Yes, you can't build. And so we always recommend that the due diligence is done on the property. And then, of course, once you've investigated the ground, how expansive is the soil? How much concrete is required? What kind of grading is required on this property? And this is before you can even go brick and stick vertical.
Yeah. But to be clear, they might be writing checks for some of these things in what we call a feasibility period, right? Or a due diligence period. And they're beginning to investigate, most importantly, the site, because that's where the biggest gotchas can come. You can pretty much architect your way out of anything. You can, like you said, once you go above ground, you can begin to design that building the way you want it. You could do prefab metal building, or you could, build Taj Mahal. But it's that feasibility that we always tell people, prepare to write some checks, because you are going to have some maybe a geotechnical report to understand the soils, or a civil engineer to give you a due diligence on the dirt and draw a draft site plan. But they won't necessarily have to write a check for the entire cost of the architect to a full set of plans. That can take months and months and months. That is something that could be, let's say with an established practice, could be drawn from their loan.
It could be drawn from
because if they're trying to get into a 0% down loan, they're saying, well, 0%, why am I writing all these checks? Help me understand that.
Oh, sure. Great question. So one of two things. Most 99.9% of the time, all borrowers are out some form of money prior to closing.
Okay.
What we're saying is should you want to be reimbursed for such expenses, as someone that is in expansion mode, we have copies of those invoices that have been paid. If you want to allocate that and make that a part of your loan budget, we will incorporate that into your loan proceeds and reimburse the borrower for the cost of such funds. It does happen. It depends on the land seller. It depends on the circumstances. It's probably another topic in itself, but we have borrowers that have identified land and their seller's only giving them 70 days to close, and they don't have a set of plans. They haven't done any due diligence whatsoever. I'm saying that's a little bit out of the norm, but we see a 90-day close, 120-day close, and you and I know that's not enough time to go through design process and have a full set of construction documents. But what we are saying is we will incorporate all costs associated with the project. And should a borrower want to be reimbursed, essentially 100% financing, that is available on an existing practice.
Okay. So that's a real important distinction. It's not that they might not write some checks up front. They might have to cover some of these costs, but several months later when they close, those funds could come back to them.
Yes.
Yeah. And it also is, I'm sure on from your perspective as the bank, it's nice to see them have some skin in the game.
It is. And Doctors by nature, I would say, are somewhat conservative. And when they're entering expansion mode, they've been a startup before, they've been a practitioner, they've been a poor student, 7 years of school to become a veterinarian. And so oftentimes what we see is their willingness to probably want a hybrid. They want some to be reimbursed, and then some other costs they don't necessarily need to be reimbursed, but they like the option that if they want cash back or if they want to finance the majority of the project without coming out of pocket too much, they like the option.
And those fees, we've mentioned most of them. I'm just wondering if we've missed any. They'll pay potentially a civil engineer, or they will. If it's a ground up, you're going to get a civil engineer involved. You're going to get an architect involved to begin the design of the building. You're going to have things like a geotechnical to study the soils. You're going to have a surveyor very often. You need to survey this. What are some of those other common startup costs?
Typically, before a building permit is issued, they'll need to pay impact fees.
And define that. What an
so
impact
I would
fee
say
is.
impact fees comes from local government. It's typically a one-time fee, and it's a fee assessed for paying for certain infrastructure costs that the city may incur for your new development, such as water, utilities, recreational facilities, parks, schools, all the things that come, traffic. Increase in traffic, they're putting that cost on the developer, which is our buyer, our doctor, instead of increasing everyone else's tax rate.
Yeah. And I've seen them as high as $5 to $10 a square foot.
Yes, I have a veterinarian in North Texas. If I told you the city, you would know. But they were constructing a 14,000 square foot facility. Their impact fees alone were $180,000.
Yeah. That's no small amount of money. So that's helpful. I think that it's important to keep in mind when you go into a process like this, especially in today's banking environment, that there will be some upfront cost, but that the borrower will very likely be writing a check for some of those. But number one, they can be reimbursed for those, or if they're loan closing, right?
Correct.
And that money is applicable if they're leaving it in the deal as equity. Correct. I think I have a lot of borrowers, a lot of our customers saying, "Are you sure if I write a check to the civil engineer? I think my banker told me that doesn't apply." It does. That's equity for their down payment.
Yes, especially in the world of SBA. I think the key distinction with SBA and conventional, we covered this on our last segment, is in the conventional world, the lender cares more about only loaning you a percentage of what the real estate appraises for.
Right. That's right. Okay. Well, so let's break there. I think we've got 4 or 5 other topics. You and I could go on all day talking about this. It's our passion, and we love to help people understand and learn. But we'll stop this one here, and we'll pick up the topic, I think, of budgeting in our next conversation.
Great.
Thanks for joining us, everybody. We'll talk to you next time.